What's up guys, and welcome back to my channel. My name's David, and today we're going to talk a little bit more about investing, but not in a retirement sense, just in a regular brokerage account. So first off, let's define what a capital gain is. A capital gain is just the difference between the amount of money that you put in and the amount of money that it was worth when you pulled it out and turned it back into cash. So if you invested $5,000 in a mutual fund and 5 years goes by and that money is now worth $10,000, you had a capital gain of $5,000. Now this is hypothetical, and we're talking about 100% rate of return over 5 years, but if you had invested about 5 years ago and you were in good mutual funds like I am, you probably would have made a little bit over 100% return on your investments. That's just how good the stock market's been doing. So that's what a capital gain is. We're going to talk about net capital gain after we discuss a few other things in this video. Oftentimes people look at investing and they think that only people who have lots of money are the kinds of people who invest. That's just not true. Any single person, including non-citizens and people from other countries, can invest in the American stock market just like Americans can invest in the European or Asian stock market. So depending on your country of origin, you're going to have a specific tax rate. America looks at it in the sense of if you're not an American citizen and you live here for more than, I think it's 186 days per year, you are required to pay a 30% capital gains tax on any gains that you've made in the US stock market. 30% is a whole lot of money, but there are also programs set up within individual countries that lessen the amount of capital gains tax you would have to pay in America, but it's all dependent upon which country you're from, and that's something you would have to figure out depending on what area of the world you come from. When it comes to regular brokerage accounts, which is just a name for an account that you invest money in the stock market inside of, there are really only two that we have to deal with. One is an individual taxable brokerage account. That's just for individuals who are not married, single as we call it in the United States, and the other kind is a joint taxable brokerage account. All this means is that you're going to be filing taxes jointly with a significant other when it comes for tax time, so they can figure out what tax rates you're going to be paying on those investments. Keeping in the theme with just two things to worry about, the other two things you need to think about are if you're going to be doing short-term capital gains or long-term capital gains. Now, anything considered a short-term capital gain in the US stock market is any asset that you've held for 1 year or less. Now, if you've only had that stock for 1 year or less, it means you're going to be in a specific tax code situation. Whereas if you've had your investments for longer than 1 year, it turns into a long-term capital gain and your tax rate is lower actually. So there's a benefit to holding onto your investments for a longer period of time. When it comes to short-term capital gains, it's pretty simple. All you have to know is what your current tax bracket is in the United States. So if you fall within the 22% tax bracket, which is making roughly $40,000 a year to $80,000 a year, as a single filer, you're going to pay capital gains at that tax rate. So if you are at the 22% tax rate, you're going to pay 22% capital gains tax on whatever gains you're going to make in the stock market. Now, the reason I don't recommend short-term capital gains and short-term investments is because 22% taxes if you're in that tax bracket is a whole lot of money. It's a lot cheaper if you do a long-term capital gain instead. So on any long-term capital gain, if you make between $0 a year and $40,000 a year in the United States, your capital gains tax rate is 0. You get to keep all of the money that you made in whichever long-term gain situation that you were in. The next level up in the capital gains bracket that you're going to deal with is from $40,001 per year all the way to $441,000 per year. If you fall within that income stream in a given year, then your capital gains rate is 15%. Now, our previous example of a short-term capital gain, if you just did something and you made between $40,000 and $80,000 a year, you're going to pay 22% taxes. So you save yourself 7% from the government taking money away from you if you just hold on to that investment for longer than 1 year. The next jump up in the capital gains tax bracket issue for long-term gains anyways is from $441,000 and up. It just goes to infinity. Your capital gains rate in that tax bracket, taxable income bracket, is 20%, which is still less than someone making $40,000 to $80,000 a year paying 22% on their short-term capital gains. Now let's go into a hypothetical real quick. Let's say that you absolutely killed it this year and you made $170,000. You also had some investments that did really, really well. Say you got into Tesla, you were only in there for about 8 months, you pull your money out and wham bam, you made a couple $1,000s on Tesla. Well, in that given situation, you're gonna have a short-term capital gains tax bill at the end of the tax year that's going to be for 32% of the gains that you made in that stock. Now, the reason for that is because if you make over $160,000 roughly in a year, you're in the 32% tax bracket, and short-term capital gains default to whatever tax bracket you're in. If you had held on to that stock for another 6 months, and you had it for longer than a year and then you sold it, you would have only paid 15% capital gains. You gave away half as much money to the government because you didn't hold on to your investment for a full 12 months, making it a long-term investment. When it comes to making money, no matter what country or where you reside in the world, you always need to be looking at what tax implications there are going to be and playing the system the best of your ability to maximize your profits. You're the one taking the risk. You're the one who's trying to make it in the world. You're the one who is cutting things out of your life so that you can invest more now, so that you can retire early and not have to work until you're 75. And you don't want to be giving some of that money away to somebody who is just profiting basically off the fact of you being risky and possibly putting yourself out there to lose a lot of money. Speaking of taking advantage of the tax system, we need to talk now about net capital gains. There's a difference between just capital gains and net capital gains, and it's pretty easy. All you have to do for your net capital gains is figure out what your total capital gains were for a given mutual fund and what your given net losses were on other stocks and mutual funds. So let's go back to our beginning example and say you had made $5,000 in capital gains. Let's say that you went really heavy in tech stocks though, individually picking out companies that you thought were going to kill it, and they ended up going out of business or just not doing well at all, and you lose $5,000. They can't tax you on money that you didn't actually make. Just because you had one $5,000 gain and one $5,000 loss, they offset each other to zero, and now you don't pay taxes on the $5,000 that you did make because you lost $5,000 somewhere else. Most tax professionals can help you take advantage of this at the end of the year, and some brokerages will actually go over it with you. A lot of them have free advising you can call for free, and some of them even have robots that will help change around your investments so that it will offset gains for losses and try to get you as close to zero as possible so you don't end up paying money out in certain years when you have really good times in some stocks and mutual funds and really bad times in some stocks and mutual funds. The other benefit to net capital gains losses would be the fact that you can deduct up to $3,000 in losses in net capital gains per year on your taxes to lower your tax bill just on your regular income. So if you do have a really bad year or the market just has a really bad year, don't be scared to report those losses, and you can itemize them and maybe get a little bit more money off of your tax bill. No matter if you're in short-term capital gains or long-term capital gains, you need to be looking at the fact whenever you sell a stock and you cash out a mutual fund or whatever it is that you're in, you need to keep that in mind and know what your cost basis is. Your cost basis is what we talked about earlier, where the $5,000 that we put into a mutual fund, the $5,000 is your cost basis. So you need to always have a record somewhere of what your cost basis is and then what you're selling that stock for, so that you can figure out how much capital gain there was, and you can just withhold the money that's going to be needed for taxes when you file a 1099 that your brokerage will just send you. Now, I know what I said probably sounds a little bit scary. I'm talking about taxes and 1099s and your brokerage is sending you stuff, but really all I have to do is look on my Fidelity app at the end of the year when tax time's coming around, and they will have a PDF called a 1099, which just has all the information on it of dividends that I've made, so that's taxable income that I have to report on my taxes for that year, and any sales with capital gains on it that I'm going to have to pay taxes on because I made money. Both of those are capital gains. And if I already know relatively what to expect on my capital gains for what I've sold, you can withhold some of that money and have it in your account and ready to go, just in case you don't have a big tax refund and you can't just deduct it off of the money you were going to get back anyways. You might have to pay a little bit out of pocket at the end of the year to get the tax man off your back. I hope you guys liked this video. Taxes can be really scary and they're a little bit weird. And if you've never done them yourself, I just recommend getting a good software. And if you're really concerned about it, it never hurts to just pay a tax professional to sit down with you and explain some things, go over some stuff, and even if your tax return isn't very complicated, it might be worth the $80 to $100 it's going to take to get that peace of mind. I hope you guys liked this video. If you have any questions on anything that I talked about, feel free to drop it in the comments. I'm not a tax professional and I don't claim to be. I just understand that you need to file 1099s and that you can get your adjustments ready for what you're going to have to pay at the end of the year just by doing some simple math. So drop a like on this video and I'll see you guys in the next one.